Record on clock. Okay. Can't do that. Let's turn off ringers. And we will start admitting people in.
Perfect.
Admitting all. Okay. We're admitting people now. And just letting you guys all know, as we are admitting people in, we are Facebook Live and we are recording. And we pretty much will start the program 1 o'clock, but we can start introducing ourselves once we get on camera. Because I would love to see your pretty faces and handsome faces. Felicia, Salvador, Sherry.
Hello, everyone. Welcome.
Please definitely unmute yourself so we can, tell us where you are, who you are, and where you're from as we let people in. Can we start with Felicia, I guess? Am I pronouncing that correctly? Or Salvador, or Sherry. There we go.
Hi, guys.
Oh, Sherry, how are you?
I'm doing great. I do apologize. I'm in a rural area with bad connection, but I'm actually, I've been following you guys. I'm actually in Savannah, Georgia. So
What's up, Georgia?
Yes, I love your guys' group and I love attending and listening to the good stuff that you guys have. So I'm here. Thanks, guys.
And Sherry, what network, and are you a government board officer?
Actually, I'm part of the Savannah. I'm part of a lot of boards down here. I'm actually really a military relocation specialist. I truly am. So I'm down at Fort Stewart today, helping guys down here get out of a program from the Home Builders Institute. But otherwise, I'm a part of the Savannah MLS down here.
Sweet. Be sure to put your contact information in there, okay? In the chat box.
Thank you, guys.
I'm a Navy vet, so I appreciate services like yours.
Yay, thank you.
And then Mr. Salvador, you want to unmute yourself?
Hey there. Hi.
How are you?
Good. Good. Thank you. My name is Salvador. I'm a real estate agent here in the in LA. My first year. Thank you. And yeah, I'm here to learn.
Well, Tony's the one, because you know what? I mean, good thing about being a real estate agent, you could be Schedule C, so you can save on taxes, and he's going to help you with that today. So welcome, Mr. Salvador.
Congratulations to joining the real estate industry.
Thank you. Yeah, it's a lot of fun. I find it fun, and I look forward to many years in real estate.
Great. Thank you. And I see we got Mr. Paul on the line. You want to unmute yourself?
Now I did it. Yeah.
How are you doing?
I'm doing good. I'm doing very good. I'm as you can see, I'm not a woman, but since you invited me, I'm here.
Oh no, we don't discriminate. We invite everybody. We love everybody.
Very good.
So tell us about yourself, Paul. Are you in the real estate industry?
Yes, I've been in the real estate industry for 43 years. My first 4 years as an agent, and ever since then as a broker. I've specialized in Malibu the entire time.
Oh.
And my wife is also in the business, and we are with Pinnacle Estate Properties in Malibu, and I'm currently the mayor of Malibu.
No, I'm so sorry. I usually recognize my VIPs. I apologize, Mr. Paul.
Well, it's because I'm not wearing a mayor hat, you know. If I had the top hat, you'd wonder it immediately, but.
Well, thank you very much, Mr. Mayor, for taking time out of your business schedule to join us.
Everybody pays taxes.
That's true.
Very true.
So maybe
Okay.
it's a good time to, hi everyone, maybe it's a good time to ask him for.
We can't, no, this Malibu's having theirs the same time as ours.
Got it.
And we have, wait a second. Oh, I just saw you, Kate Timpson. You went away.
And hi Tony, thanks for your help the other day.
Hi, Cindy.
Yeah, we had Kate, and we have two. We have Catherine and Kate, Catherine Newton, Mo Simmons, Gary, Maria. Please unmute yourself and introduce your area. If you're a Women's Council member, which network?
Hello, everybody. Can you hear me?
Yes.
Hi,
Yes,
this is
we
Mo
can.
Simmons. This is Mo Simmons. I'm a realtor at Exit Realty Horizons in Wauwatosa, Wisconsin. I am currently and will be the president-elect for the Milwaukee Women's Council chapter.
Yay, congratulations.
Yay.
And Maria or Annie? And I see we have
Hello?
our,
Oh,
go ahead.
Hi. Oh, I just jumped on, so I'm watching. I don't know what's happening.
Annie, can you tell us if you're a realtor, Women's Council member, and what area you're from?
Sure. Hi, I am Annie. I'm a realtor. I have my own brokerage, and I'm from Los Angeles, Greater Los Angeles and Orange County area.
Welcome.
Thank you.
Welcome.
And it's 1:02, so we're gonna go ahead and get the program started. And we would do more intros and networking afterwards, after Tony does his presentation. So we'll go ahead and get started and welcome everyone. Our production producer will get our program started. Okay, so I'd like to welcome you all to our Use It or Lose It, the countdown for the year-end tax planning. Just a quick housekeeping, we are recording and streaming live on Facebook. My name is Tawny English. I am the 2021 past president and the 2022 treasurer of our LA-Beverly Hills network. We are your Los Angeles connection. I am joined today by our 2022 president, Hiroka Newman, who is also running our production. She is our producer. And we also have, and I will introduce actually the rest of our government board when we get to that section actually. And before we get started, I would like to acknowledge all of our VPs that are on the call, but I think we're still have people coming on. So I think I would do that afterwards to acknowledge everyone so I don't miss anyone. So for right now, let's get started with the next slide, Madam President.
Just a minute. Just a minute.
Okay, so as our network is the Los Angeles Beverly Hills Women's Council Network, and this is our 2022 government board members. We have our president, Madam President Hiroka Newman, our president-elect Cindy Wu.
Hi everyone.
And she's right there, hi, and she's here. We have our first vice president, Ann, I think nope, that's on right now. We have our director of membership, Marissa Fletcher, our director of program, Mary Perdomo, and our director of strategic partners, Toy Holiday, and our director of marketing and PR, Rachel Crowley. And we also have on the line today, our 2021 past vice president, Janine Gershon. And then who are Women's Council members? We are highly successful professional realtors and real estate practitioners. We earn more than 2 times the average realtors. We've been in the business 25% longer than the average realtor. We generate an average of 50% of real estate business from referrals. We have a referral mindset. We love referring to our sister. Our total membership nationwide is 12,000, and the total local and state networks combined nationwide are 253, and we were founded in 1938. And the 5 top reasons to join Women's Council is 1, we're a top referral network. 54% of our members send out 1 or more referrals to another Women's Council member. We earn on average $15,000 in commissions from referrals. We have a robust online referral system, and our numbers tell it all. The average Women's Council member earns $134,000. Women's Council members are sought after and leaders. 65% of us hold leadership positions and in the community are in business. We, Women's Council members, hold 20% of NER committee positions, and we have great business leadership training. We offer over 1,500 personal and business leadership development opportunities nationwide. We have the flagship PMN designation, and it's all about connections. We connect, we party together, we love each other. And of course, we have member benefits. You can get discounts on rental cars, shipping, closing gifts, tickets, office supplies, flowers, gift basket, and prescriptions. And the reason to join our particular network, we are awesome. We did so many educational virtual events last year, like Unleash Your One Word. We had the Tony Robbins Peak Performance Workshop. We had the High Heel Leader. We had our Hump Day Know Your Market, where we did market updates. We had the Divorce Niche. We had the Divorce Niche with Laura Sparks. We had, pre-listing, how to save your real estate transactions with pre-listing inspections. We had our Diversity Celebration virtual events, which was the first time in its history ever done, as far as we know. So we held one for our Black leaders, our AAPI leaders, our Hispanic leaders. And then for Women's History Month, we held a mega nationwide networking. And then our in-person events, we had a great Brazilian carnival event with the Miss Joyce Ray, the billionaire broker. So we had, as you see, we danced, we had our Beverly Hills mayor, by the way, mayor of Malibu. We had him there. So we're definitely have you be one of ours in 2022. We had our Wine Down Thursday event, which we enjoy good wine and good food. And by the way, our Wine Down event, all of our wine bottles had our strategic partners labels on it. So it was our 2022 wine collection from our top strategic partners, including Robert Hall, by the way, Mr. Tony Rawson. And then we had our last live event was Real Estate Horror Stories Happy Hour, which we discussed. We had our top strategic partners really discuss how to avoid your real estate transaction from being a horror story. And then what's coming up is our 2022 board installation dinner at Evening Affair in Santa Monica. And that's on December 9th at 5 p.m. at 12104 4th Street in Santa Monica, California. We'll be having our 2022 President Kay Merg install us. De-installing us is our 2021 State President, Rosanna. And de-installing us will be our 2019 President Fiona, and our 2021 president will be one of our featured speakers. So definitely get your tickets as soon as possible because early bird tickets ends on November 23rd. And we'll have our keynote speaker, Michelle Lando, who's the CEO of Skill Set Communications. So she's going to be awesome. And then we'll have our special 2028 national president will be one of our special guest speakers. And she also was a Women's Council president. And we're also going to be hearing from Mr. Mark Kitabashi. I hope I didn't torture his name too much. He's going to be giving us a great wisdom of, pearls of wisdom, I like to say. And he's the 2022 Global Coordinator of Asia Pacific. And our featured speaker is our past National President of Women's Council and our 2022 CR Treasurer, Heather Azor, also known as the Dragon Slayer. So we are looking forward to you guys coming to our installation. We have great tickets. Right now, it's $100 by November 23rd. If you're a member of Women's Council, it's $90. If you're LA-BH member, it's $75. And we have all these great special discount pricing. You buy 4 tickets at $350, 8 tickets at $700, or become one of our great, awesome event sponsors at $2,500, $1,000, or $600. And we will be putting in the chat box the link to buy your tickets. And our strategic partner is our association at the diamond level, which is Greater Los Angeles Realtors, our awesome CEO, Marty Nash. And then these are our strategic partners. A lot of things, we cannot do these events, especially offer them for free without the support of our strategic partners like Greater Los Angeles Association, Tawny English Lions Realty Group, Jonathan Paris from Visual Open House, Chris Griffin from La Roca Inspection and Check Companies, Raymond from the Green Box Loans, and Carly Saltzman of PNC Mortgage, Nick Ramirez of Goosehead Insurance, Mike DeLisio of Robert Hall and Associates, with Tony is representing today, Tony Watson, and Errol de Guzman, president of Termagon, Mindy Reagan of My NHG, and Annie Ives of the MLS. So,
We're gonna run the video.
yes, now let's get to know more of our strategic partners.
Can you hear?
Yes. Turn up a little more. Yep.
Hi there, my name is Carly Saltzman. I'm a mortgage loan officer based out of Los Angeles, California, and I love mortgages. And the reason I do is because I love to connect with people from all walks of life and to help them see the bigger picture of their financial goals. Each individual is different, therefore each real estate transaction is different. And it's important to be flexible, malleable, and to see what your clients need and what they're asking for. A real estate transaction doesn't necessarily need to be a scary thing. My passion is to dissect the unique needs of my clients and make sure that their home lending process is as smooth as butter and really just a pleasant experience in the end so they can enjoy their home.
Okay, next one is coming up soon.
Hello, I'm Nick Ramirez, agency owner of Goosehead Insurance in Encino. For years now, we've been helping realtors just like you help their buyers find the best deal for home and auto insurance in the state of California. When you're in escrow on a purchase, you want to make sure to refer your clients to a skilled agency who can make sure to not only provide a memorable experience, but also ensure that you close escrow on time every time. Whether you're representing a first-time home buyer or a skilled investor, our agency knows how to customize the right coverage and present the right experience to the right client, making you look fantastic. And if there's one thing I want you to remember, is always encourage your clients when you refer them to bundle home and auto insurance, because every zip code has different rates and it's important to get the best deal you can every single time. With over 185 star reviews, we're excited to work with you.
Two more videos.
Hello, my name is Chris Griffin. La Roca Inspections was founded in 1994 to serve your clients' needs for their home inspections in the greater Los Angeles area. We offer the four most common home inspections: the general physical, the sewer line, the mold inspection, and the chimney inspection. If there's an inspection your client desires that we don't offer, we have an extensive list of contractor referrals and inspectors on our website. Go to our website for contractor referrals and get your free copy of our Buyer's and Seller's Guide to Inspections. We are your go-to resource for multiple inspection services and annual property reviews for homeowners. We look forward to working with you in the future. Thank you so much.
Now the last one is our guest speakers company.
Robert Hall and Associates is an award-winning tax consulting firm based in Southern California with a heavy focus on real estate ever since its inception. We've been helping people structure their real estate holdings and optimize write-offs since 1971, and we are very good at what we do. Given our expertise in real estate, we take a much closer and nuanced look than other firms. In light of recent events, it's important to know how to structure your holdings. Our firm is well abreast of the latest asset protection strategies, but we are also well attuned to the recent tax code changes and all the many write-offs that are available, which we do with our full staff of enrolled agents. Many clients say our unique selling proposition at RHA is we provide all the up-to-date real estate tax expertise without you having to engage with a CPA. All at transparent pricing schedules as we charge by the form and not by the hour. Remember, it's not about how much money you make, but rather how much you get to keep. Feel free to give us a call for a complimentary consultation that allows us to take a look at your past couple of years' tax returns to see how much we could have saved you. This consultation is there to make sure you're taking advantage of every possible deduction. Give us a call today for your free consultation and join the ranks of our other satisfied clients, which you can find online with a quick search.
Okay, so I have the pleasure, well, you know what, before I go there, I think we have some people online. I want to go ahead and just quickly acknowledge our VIPs we have on the line. And first, I definitely want to again say hello to our Mayor of Malibu, Mr. Paul. Thank you for joining us. And I see that we have our 2022 president on the line, Kay Merg of the California. And let's see, I don't want to miss everybody. I know that I saw Kate Timpson, who's a local 2021 local president. So I would like to say hello and welcome to all of our 2021 and 2022 network presidents, along with our 2021 and 2022 government board officers. Welcome and thank you for joining us. And so right now I have the pleasure of introducing one of our top supporting strategic partners. And as you know, we cannot do events like these without the support of companies like Robert Hall and Associates, who happens to have locations nationwide, by the way. Robert Hall specializes in working with real estate agents and their clients, especially in complex real estate transactions where there could be a hefty tax consequence. So please do have them come out to speak at your networks, at your association, because they also happen to be one of our association affiliates, and definitely reach out to them personally. Our featured speaker today is from Robert Hall. His name is Tony Watson. He's an enrolled agent, which for those who don't know what an enrolled agent is, they're certified by the IRS, the Internal Revenue Service, as a tax specialist, like myself. I was also certified, by the way. Tony focuses on providing personalized financial guidance and tax preparation services to individuals and businesses. As a federal licensed tax practitioner, Tony helps his clients make sound financial decisions and works to ensure all eligible deductions are received when preparing taxes. Should a client needs assistance with audits, collections, or appeals, Tony is empowered by the U.S. Department of Treasury to represent taxpayers before all administrative levels of the Internal Revenue Service. In addition to his one-on-one client work, Tony Watson is the keynote speaker for Robert Hall and Associates. He has spoken for hundreds of trade organizations throughout the state of California. His dedication to his clients and expertise in the field of taxation has led him to win the Glendale Reader's Choice Award for Best Tax Preparer in 2016. Tony not only works in the real estate industry, but he also worked with small businesses, entrepreneur startups, entertainment, healthcare, law enforcement, firefighters, and education. So if any of you have clients in those industries, call Tony. Especially if you're targeting those specific industries and want to hold home buyers and seller educational webinars, call Tony. So no, without any further ado, we're turning it over to Mr. Tony.
Thank you so much for having me today. I really appreciate the intro. That's a beautiful intro. Thank you so much for that. And, you know, just like, you know, anything in life, you know, the importance of taking a stronghold of your financial situation, your positioning before the end of the year. It probably is hard to see the light at the end of the tunnel of the pandemic, but we are coming to an end, I believe, at least, even though California continues to be in a little bit of a shutdown. But we also have this new internal revenue code kind of looming on the horizon that hasn't been passed as of today, but they should be voting on it this week. I woke up this morning at 5:30 a.m. with my 3-year-old, and I'm usually making him breakfast as well as having my tablet out there getting any updates that happened over the previous 24 hours or just throughout the night. And as of today, nothing's passed for 2022's tax code, at least. But as we approach the end of the year, it's really important for us to once again take a stronghold of our financial situation and put a plan in place to ultimately win on our tax returns, right? You know, a lot of people find that tax season is the busiest time for their tax advisors and their tax preparers, when in fact, that should be a pretty straightforward process from a tax preparation standpoint, because the year is already over. Year-end planning happens to be, in my opinion, one of the most important times of year for self-employed individuals, business owners, investors, so on and so forth, because you need to wrap up the year. You need to close it out. And so today's topic is use it or lose it, the importance of year-end planning. We're going to talk about some really great tax write-offs that you can take advantage of prior to the end of the year. We're going to talk a little bit about the changes to the tax code on the horizon under the Green Book that the Biden administration has already introduced, which is basically a wish list of what they would like to change. But once again, nothing has passed as of today. And then we're going to also talk about what the do's and don'ts are from a estimated tax payment standpoint, who's required to prepay their tax, and some other options that you may have going forward into the tail end of Q4. Once again, the introduction was great, so I'm not going to tell you any more about myself, except for the fact that I've been doing this 17 tax seasons. This 2022 will be my 17th tax season with the firm. And as the keynote speaker, I have been able to do over 140 webinars since the beginning of this year alone, starting last March and April when the pandemic started to set in 2020. We switched everything over to digital platforms. And so I think that over the course of the pandemic year to date, we've been able to do well over 220 to 230 webinars. So we're all about education here at Robert Hull & Associates. Like you had mentioned, we've been around since 1971, so some of you may have already heard about Robert Hull & Associates. We unfortunately are not the winery, the Robert Hull Winery. I wish we had a connection there. That would be a great relationship to have, but it just happens to be the same name. But Bob Hull has quite the legacy here in the Southern California area. And even though we have one location in Glendale, California, we do service tax filings in all 50 states. So for all of you who are not here in California or based here in California, we can absolutely assist with any of your tax filing needs elsewhere in the US. And currently, we're assisting clients with well over $1 billion in real estate transactions, operations, wholesaling, rehabbing, basically anything in the real estate field, as well as small business. So we do see a lot here at Robert Hull & Associates. Kind of a one-stop shop. Tax preparation happens to be our main service, but we incorporate businesses. We do payroll, we do bookkeeping, we do audit representation. So we're a little bit more than just income tax preparers. And we do offer free consultations. I will pop this back up at the very tail end of my presentation today, but I want to get into the bread and butter today. So why is it important as we approach December 31st to get a better positioning for ourselves from a tax planning standpoint? Most people will say it's to avoid unnecessary penalties and interest, which I absolutely agree with. However, because I work with a lot of small business owners and real estate investors, I find that a greater percentage of my clients would rather keep the money in their bank account, paying the 3 or 4% interest and penalty amount, but controlling the investment opportunities on their end by keeping the cash in their bank account as long as possible. And at the end of the day, if you keep 40, 50 grand in your bank account without prepaying tax, you have to make sure that at least whatever you're investing that money in is going to return you more than a 4% ROI to at least cover the potential penalties and interest you're paying on the back end. I am not promoting that people do that, but I tend to find that real estate investors and small business owners would like to play that game over prepaying the tax throughout the year. So we can definitely sit down and map out some of those very unique calculations for our clients. Another reason to do proper year-end planning is to position yourself in a better light. As we approach the end of the year, a lot of people are looking to reinvest their profit back into their businesses, either making those necessary improvements to their rental investments or upgrading computer equipment, office furniture, maybe even purchasing a work vehicle to accelerate that write-off and take bonus depreciation and pay less overall income tax, because that's the goal. Remember, like you had mentioned earlier, it's not about how much you make. It's not even about how much you spend. It's about how much you get to keep at the end of the year. And so I have trained myself over the past 17 years to not so much think of it as tax savings, but to think of it and promote it as wealth retention, right? Because if you save yourself $20,000 in tax, that's you effectively retaining $20,000 more of the wealth that you've built for yourself over the past 365 days. So maybe rethinking the strategy from a wealth building standpoint versus a tax planning standpoint that may make your appointment or even thinking about taxes a little bit more interesting from a business or investment perspective. Last but not least, aside from positioning yourself, it's also for peace of mind. People want to know their tax liability ahead of time. And if you don't do planning throughout the year, and we all know the phrase failing to plan is ultimately planning to fail, when you get ready to file your tax return next tax season, if you didn't put a plan in place and all of a sudden you have a surprise liability because of liquidation of a retirement account, or maybe your income shot through the roof in 2021, but you were thinking that it was pretty comparable to maybe the year of 2020. Those are not great surprises, right? Especially when it comes to filing taxes. Nobody wants to be surprised in that way. So it's peace of mind to know this is how much I'm going to owe before the end of the year, having the ability to either prepay it or at least set the money aside so that you know that you have it saved to pay the liability when you file. So peace of mind is a big thing in the tax industry, just to know that there are no surprises on the horizon. Whether it's the first, second, or third option or the approach to tax planning, I think it's going to be important to people in different ways. People with families, people who are single and building a business, people who are selling and transacting real estate. All of those things play into the bottom line on your tax return. Credits from claiming dependents and capital gain requirements and tax implications for selling a rental investment. These are all things that you should not try to navigate on your own. You should always be in constant contact with your tax advisor, making sure that you're bulletproofing that situation at every corner or at every angle. Before the end of the year, this review appointment that I call year-end planning in the tax industry is normally called a W-4 review. People get confused with this though, because a W-4 review is really the review of exemptions or withholding on a paycheck stub. So the W-4 review is mainly for employees. It's to figure out, hey, have I prepaid enough through my paychecks to not owe anything when I file my return next year? But we also call the review for self-employed individuals a W-4 review, because instead of reviewing paycheck stubs, we are reviewing with a self-employed business owner your year-to-date income, your year-to-date expenses, and then to calculate a bottom line and figure out what kind of liability you'd owe if nothing has been prepaid, just to give you options, right? That peace of mind and then having options of what to do before the end of the year to potentially avoid penalties and interest, to save you even more tax by reinvesting profits back in infrastructure. These are all great strategies for self-employed business owners and real estate investors to use. What does the government actually require us to do? Well, I mean, at the end of the day, if you don't prepay your tax, you do pay penalties and interest. So if you want to follow the guidelines of the Internal Revenue Service, they lay it out pretty simply. They say that by the end of the fourth quarter, which actually is not December 31st, the end of the fourth quarter in the tax industry is January 15th of the following year. So by January 15th of 2022, in order to avoid penalties and interest, you have to cover one of two calculations in overall payment and liability coverage. Either 90% of your current year liability or 110% of the previous year's liability, whichever is greater. Now, let me give you an example. If in 2020, business was a little bit slow because of the pandemic, and then with interest rates being frozen and locked at very low rates, let's say that your commission sales skyrocketed in 2021. We're tending to see this happen, and it's pretty common nowadays. And so if you had lower income in 2020 and you were given estimated tax payments based on your 2020 income, and now 2021 is double, triple, quadruple what your revenue was in the previous year, paying 90% of your current liability would be the better approach, Because if you go off 110% of 2020's liability, it might not be enough to cover the 2021 tax liability. It might not even be up to 90% of the current year liability. So the importance of year-end planning is really just around trying to figure out a plan for yourself. Should I be prepaying all of this liability? Do I have some other unique opportunities that need, that call for more of my cash to be liquid? But at the end of the day, if you are that person that does not want to pay penalties and interest, you have to cover 90% of the current year liability in prepayments by the end of the fourth quarter, or 110% of the previous year's liability, once again, whichever is greater. And that is all through a year-end consultation, year-end planning consultation, or even a W-4 review. Some of you might be married and your spouse might have W-2 income and you have a self-employed business. Even more of a complicated scenario on your end, but actually a pretty straight scenario or planning session from a tax perspective. Your spouse who has the W-2 has already prepaid most of the tax on the earned revenue from that year. And so the planning really isn't for both of you. We will include all of the federal withholding and all of the taxes already paid in the calculation. But the main goal is to sit down with the self-employed individual and map out the year-to-date income and year-to-date expenses. That will give us a good idea of what you are up against when you get ready to file for 2021 in the 2022 tax year. So let's talk about some top tax write-offs moving into the end of the fourth quarter, because it's November 17th today. So we still have plenty of time to reinvest profit back into infrastructure and be able to reduce our taxable income. One of the top write-offs that we've seen so far in 2021 for especially real estate investors and real estate professionals is marketing and advertising. I can't tell you, compared to 2020, where marketing and advertising was a very low cost for business owners, even though they were still at home developing their websites, creating new flyers, mailers, so on and so forth. 2020 was a very unique year as a whole. In 2021, when people started really getting back into the momentum of doing business, getting their vaccines or being able to operate even with a mask on and actually able to go out and still not really shake hands, maybe do a fist bump or whatever, 2021 compared to 2020 is night and day from a business perspective. And so we are seeing a lot of real estate professionals, a lot of self-employed business owners pumping about 10x on average into marketing and advertising. They are seeing very unique opportunities on the horizon. They're seeing other businesses and other professionals shutting down their businesses. So they want to pick up more connections with businesses that are no longer around or open. And so we're seeing this to be one of the largest tax write-offs in the tax year of 2021 coming out of the pandemic year. Number two would be supplies and equipment. I mean, let's face it, in 2020, when we were all forced to work from home for a certain period of time, we all had to upgrade our computers. We had to buy printers. We had to buy larger desks and more comfortable chairs, outside of where we were normally working in our office space in brick and mortar. So professional supplies and equipment are also great tax write-offs. And the reason why I like professional supplies and equipment so much from a tax perspective is, number one, they have one of the lowest risks for audit. Let's face it, how many people do you know in a professional setting who can do what they do without a computer, without a cell phone, without a printer, without a fax machine, without a desk or a chair to work from? So obviously the federal government knows that these expenses in particular are some of the more common business expenses that self-employed individuals will have. Number two, the reason why I like these deductions is you have options of how to write them off. You go out and you purchase a computer, and let's say that this computer was a $3,000 or $4,000 purchase. You have the option of either accelerating the write-off and taking it all in 1 year, taking the full benefit in 2021, or you have the option of taking this depreciable item and spreading the deduction out over the lifespan of the asset, which a piece of equipment has a 7-year lifespan, furniture and fixtures, a 5-year lifespan, cars, automobiles, work vehicles have a 5-year lifespan. So these items, these tangible items have depreciable lifespans. Now, why would you not want to take it all in 1 year? That's probably a question that you're asking yourself. Well, let's say that you've already spent all of your profit by reinvesting that profit back into your business, and you're at a net zero profit. So you're already paying no income tax. Why would you, and unless it's necessary to kick yourself into a loss and offset other income, if it's not benefiting you to take the write-off this year, why would you accelerate it and take it all in 2021? So you have options. If you are looking forward into 2022 because you've already offset all of your income, you can carry this deduction forward into future years when you actually need the additional write-off. So once again, I love these deductions for a number of reasons. Number one, lower risk for audit. And number two, options of how to deduct these expenses against self-employed income. Number three, car and truck. I'm sure that all of you are aware that starting in 2018 under the 18 reform bill, the tax reform bill, the Trump administration had brought back the bonus depreciation on large vehicle purchases. So if you were to go out and purchase a 6,000 pound or heavier Chevrolet Tahoe or a Silverado or a Tesla Model X, which weighs over 6,000 pounds, it qualified for something called bonus depreciation in 2018, 19, 20, and even in 2021. And what that means is that if I had $100,000 in net profit through my business, and I was looking to go out and acquire a work vehicle, such as a Chevy Silverado, let's say, and I wanted to pay 60 grand for this vehicle, instead of having to depreciate it over its 5-year lifespan, since 2018, I've been able to take it as bonus depreciation as a write-off, making the full $60,000 vehicle dollar for dollar deductible. So my $100,000 in profit is now being reduced by $60,000, even though I only put, let's say, $5,000 down on the pay or on the vehicle purchase and I finance the rest. It doesn't negate the fact that it still qualifies for bonus depreciation, giving you the full deduction of 60 grand all in 1 year. Whether you purchased it January 1st of 2021 or December 28th of 2021, it still qualifies for that 100% bonus depreciation benefit. So we're seeing a lot of people out there shopping for new vehicles. I would never send a client out to buy a vehicle solely for the tax write-off. We're talking really only about the taxpayers who were already actively looking for a new work vehicle. And this just happens to be the perfect storm, right? They're already looking for the vehicle. We need to capture it in a very specific way to accelerate the write-off for the business owner. And that will allow you to shelter, in this case, let's say a $60,000 amount of their income that pays absolutely nothing in federal income tax. Now, this all sounds great, right? From a federal perspective, these are great ways to shelter some of your income by just reinvesting your profit back into infrastructure and into your business. But who does not accept this bonus depreciation ruling? The state of California. So even though you might be showing in this scenario $40,000 of profit rather than 100 grand, the state of California will not allow the full $60,000 accelerated write-off. So the state of California liability might be very similar to your federal liability, even though your liability or state tax rate is much lower than the federal tax rate. So it comes full circle, the importance of planning ahead, right? To figure out, hey, one, how should I take title to this vehicle? How should I insure it? And am I going to get the full bang for my buck and be able to dollar for dollar deduct this purchase in 2021? So have this conversation with your tax advisor. If you are not looking to lease or to purchase a new vehicle, then you have other options of what to write off for car and truck expenses, either mileage, and that's at about 55 cents per business mile, or not and, but or actual car expenses, meaning engine repair, tire replacements, oil changes, so on and so forth. So you have to kind of weigh which one is going to give you a greater overall tax benefit. Mileage tends to be the go-to route for the deduction. Mileage is one of those kind of he said, she said write-offs. You prove it under audit with your own mileage log. And so the government allows that under audit if you do track your mileage through a mileage log. And there's a really great smart device app called Mile IQ. I'm sure that some of you have heard of it, but Mile IQ has actually been used under audit with the Internal Revenue Service as proof or evidence or to create a legitimacy behind the mileage deduction. So always be aware of that. Number 4, legal and professional fees. For most taxpayers here in the United States, they lost this write-off in 2018. For instance, if you're a W-2 wage earner, you used to be allowed something called non-reimbursed business expenses as deductions on your individual return. But starting in 2018, those non-reimbursed business expenses disappeared completely if you were a W-2 wage earner. But nothing changed for the self-employed business owner. Self-employed individuals still are allowed the full deductible benefit of legal and professional fees on their return. So anything you pay your tax advisor to file a return, anytime you hire an attorney to review a contract or draw up a lease agreement for one of your rental investments, these are great ways to dollar for dollar reduce your overall self-employed taxable income or your rental property cash flow income. So be aware of that. Great dollar for dollar write-off. Last but not least, and I'm not going to spend too much time on this because this is kind of a rabbit hole. I could talk probably about property deductions for the full hour presentation, but I'm going to dial it into only a couple key parts of what I think are really unique deductions and unique ways to reduce overall income and pay less tax. Obviously, we were talking about property tax and mortgage interest. Those are the most common property deductions. But then we also have to note the in-home office deduction. Coming out of the pandemic with more people working from home than ever before, probably in the history of the United States, is the in-home office going to have the same risk or level of audit? Is the government going to be allowing people to take larger deductions for in-home offices because we were forced to work from home? Well, I have both a professional opinion and a personal opinion, and they're both the same, in fact, in this scenario. Professionally speaking, I do think that in-home offices will continue to have a higher risk for audit. Number one, because I've known over the past 17 years, it's not the actual form that gets people audited. It's the misallocation of or unreasonable allocation of office square footage versus total square footage of a home. And let me dive further into detail about that. Let's say that you live in a 4,000 square foot home here in Southern California. That's a big property, right? And let's say that you've read online that the industry average of allocated square footage inside of a house is 25%. So you go to your tax return and you plug in 25% of 4,000 square feet as your in-home office space. That's 1,000 square feet of your home that you're saying that you use for office space. 1,000 square feet in a primary residence, that is a massive office space, right? That's bigger than the office that I work from here at the Robert Hall & Associates building. And I have a pretty decently sized office. But what you're telling the government is that truly 1,000 square feet inside of your house is used solely for business, meaning there's no bed in your office, there's no baby crib in your office, there's no elliptical machine in your office, there's no toys or dog beds or anything like that. It truly is a space solely used for business purposes. This deduction, in fact, is one of the few deductions where the government can physically visit your home to verify the square footage. They can actually come to your house and measure it if you are audited or under audit with the federal government. So we want to avoid that at all costs, right? But personally speaking, I do believe that people are afraid of this deduction for the wrong reasons. And therefore, they fear taking this deduction on their individual return, when in fact, there's a whole 2 or 3 page part of the Internal Revenue Code that states that in-home office deductions are ordinary, necessary, and legitimate. They very much meet all of the requirements under Internal Revenue Code for it to be allowed as a write-off for a self-employed individual or a business owner. So if you are working with a tax advisor that has told you in the past not to take this as a write-off out of fear of it being audited, you're working with the wrong tax advisor. First and foremost, if it was ever audited, you don't go and represent yourself in front of the IRS. We go and represent our clients in front of the Internal Revenue Service. So we would never put you in a position on the tax return filing wise where we could not argue that position. It would be, a bad business essentially to do things on your return that we could not justify under audit. So professionally and personally, I do think that it will continue to have a higher risk for audit. So what I tell my clients is, hey, let's not be fearful of taking the deduction. Let's just be reasonable with the allocation. Now, 25% was that scenario that I gave you. That was the 1,000 square feet out of 4,000 square feet, a 4,000 square foot home. But let's say that your home is only 1,000 square feet and you take 25% of it. Well, 250 square feet is a more reasonable allocation for an office space. Now, if truly you have 1,000 square feet in your home that you use for business because you run an online Amazon store and you keep all of your inventory in your garage, and then you also have a dedicated office space inside of your house, and you can include the nearest restroom as part of that square footage. If you truly use 1,000 square feet, take it as a write-off. At the end of the day, that is a legitimate write-off for you as a business owner. I find that most of my real estate professional clients, they not only have an office that they work out of, but they tend to have a dedicated space inside of their house, but not 1,000 square feet of their home. So once again, it is a very much an ordinary, necessary, and legitimate write-off, but above and beyond all 3 of those requirements, I say let's be reasonable with the allocation. And let's try to be as accurate as possible, making sure that truly you are only deducting the office space. So that's for the in-home office. The mortgage interest and the property tax deduction, still great overall write-offs. At the moment, there is still a cap in 2021 on our state and local tax deductions, which is capped at 10 grand. Under the Biden administration changes, that could jump from 10 grand up to $80,000, meaning that there will still be a cap on your state and local tax deductions, but it could bump all the way up from $10,000 to $80,000, now allowing many US taxpayers to fully deduct their property taxes and their state income tax as write-offs. One thing that they also are talking about changing, though, and this is where a lot of the misinformation comes out and is talked about in the news media outlets and in trade journals and things like that, is that, that sounds great in theory, but when you are a tax professional, I also want to know when they do that, when they bump it from 10 grand to 80 grand, what are they going to do with the part of the Internal Revenue Code called alternative minimum tax? Now, I don't want to bore you with the details here, but prior to 2018's tax reform bill, when the $10,000 cap was introduced, there was technically no cap on your state and local tax deductions that we saw. If you had 30 grand in state and local income tax, you saw $30,000 as a write-off on your return. And so in theory, you saw it on your return, so you thought you got it fully as a write-off. When in fact, if your household income was at or above roughly about $200,000, you may have been subject to something called alternative minimum tax, or also known as AMT. AMT has been around since the early 80s. So it's been around for a very long time. And even though you saw that $30,000 write-off on your return, thinking that it was fully allowed as a deduction, if you were subject to alternative minimum tax, you were already being limited, if not fully disallowing the state and local tax deduction on your individual return. So even though you saw it there, it might not have been a write-off for you anyway. That was kind of the tricky part of the AMT part of the Internal Revenue Code. In 2018, even though they introduced a $10,000 cap to state and local tax deductions, they increased the AMT threshold from roughly about 200 grand all the way up to $700,000, meaning that less people were subject to AMT, so they were being allowed their state and local tax deduction, but only $10,000. So everyone was impacted in a different way in 2018. In 2022, if they bump that $10,000 amount up to 80 grand, I am more interested not in how much that's going to save my clients. I'm interested on the back end what they're going to do with alternative minimum tax. Because if they repeal the AMT change from 2018, you might think this is a great change, but it might not impact your bottom line at all if you are now subject to AMT again moving forward in 2022. The reason why, and I feel like people's eyes are rolling back in the back of their head now, the reason why I wanted to go into detail about that is to show you how complicated the Internal Revenue Code is and will be. It'll never be easy to understand. That's what creates an industry where I feel like I'm gainfully employed year in and year out, because I get paid to learn this. For those of you who are real estate professionals, I know that, we have a fellow EA in the audience here, but for those of you who aren't interested in learning Internal Revenue Code, this is why you hire licensed tax advisors to learn the code for you and to find the back end ways to convert money into, tax-free growth retirement accounts, to figure out ways around alternative minimum tax limitations, to figure out ways to create more of a benefit with taking an in-home office deduction, allocating a little bit of the overage of property taxes to the in-home office deduction. And so there are a number of games that you can play. That's why you hire people like us, okay? I can tell you right now, and this is out of a journal, or an article I read this morning, that in 2022, if the Green Book, as it's stated now, the Biden Green Book, if it does fully pass, this will create a top tax rate just on the federal side of roughly about 42.9%. Now, this is not based on the 37% bracket. This is based on the 39.6% bracket change, plus the 3.8% net investment tax, plus all of the changes for investment income tax that could be wrapped into an individual high income earning tax filing. 42.9% for the wealthy of the world. Listen, if they're making billions of dollars, they'll pay the 42.9% and still be billionaires. Let's face it, still going to have their jets, their helicopters, their boats, their 15 homes across the world. It's not really going to impact them too much. But if they start to change the tax rate too much for corporations, which they are talking about doing, taking the C corporation tax rate from 21 to 28%, I believe, the shareholders are still going to want to see their annual profits. They're not going to want to take losses on that. And that taper off impact where they start to cut overhead or operational costs means there will be less jobs for the US economy. It's just the natural ebb and flow of how the economy works here in the US when tax rates are high or tax rates are low. So just be aware that that will happen over the next year, 2, 3 years, however long that's going to take for us as US taxpayers to feel the impact. But this is going to be the most significant change to the Internal Revenue Code, dating all the way back to probably the 1920s. Just be ready for all of these changes. And once it is finalized, I'll bring back a whole new presentation to give you everything that has been set in stone and passed into actual law or code. The difference between a primary residence mortgage interest deduction and a rental property mortgage interest write-off, it's pretty much self-explanatory from a tax perspective. Primary residence, you have limitations on what you can deduct in mortgage interest. Starting December 15th of 2017, if you had purchased a home after that date, you are now only allowed the mortgage interest write-off on the first $750,000 of debt. Prior to December 15th of 2017, if you had bought a home prior to that date, you were allowed the mortgage interest on the first $1 million of acquisition debt. So there was a little bit of change in the mortgage interest write-off if you purchased the property prior to that date or after that date, starting at the tail end of 2017. With a rental property, because it is a business, remember businesses generate revenue, they have expenses. So with a business, there is no limit to the amount of mortgage interest you can write off. There is no limit to the property tax deduction either. So you can see the power behind owning a business. And this has always been the case under Internal Revenue Code. For the past 17 years that I've worked in the industry, for the past 50 years that Bob Hall has been in business, the tax code web has always been spun to give benefit to the self-employed individuals of the world and the businesses of the world, because they know that you are the true stimulators of the US economy. The workers of the US economy, sure, we spend our W-2 wage earning payroll checks, and that is cash circulating in the US economy. But me working for my employer doesn't mean that I'm creating jobs for the US economy, right? Or directly, I'm not creating jobs, whereas business owners are creating jobs for the United States economy. And so the tax code has always been built to benefit business owners. And that's why when I find that self-employed individuals don't plan ahead to structure themselves or position themselves in ways to reduce overall liability and retain more of their wealth, I think that that's a very silly approach to being a business owner. The one thing that puts people out of business the fastest is not having a plan in place, not being able to weather the storm of a pandemic, right? Not having enough in savings, not being able to pay less tax because they haven't reinvested profit back into the right types of assets. With rental properties and with self-employed businesses, the importance of year-end planning is there, and it's definitely something that you should absolutely take serious and put aside time towards the end of the year to meet with your tax advisor. Do you actually have to make those estimated tax payments that we discussed earlier? Well, it depends. Like I had mentioned, I have some self-employed business owners who'd rather keep the money in their bank account and pay when they actually file the tax return. And yes, they are aware that they pay penalties and interest on that money. But the penalty and interest rate essentially is roughly between 3 and 4%. It could range a little bit higher depending on the size of the liability. But at the end of the day, if you're willing to pay that 3 or 4% by knowing that, keeping that money in your bank account and investing it in other things that you'd like to invest in will return you 10, 15, 20 cents on the dollar in ROI, wouldn't that make sense? I mean, if I can get a 20% return on my investment and pay a 3 to 4% penalty on the back end, I'm still walking out ahead about 15 to 16% on the dollar. So I'm not pushing people to do that, but this is very much a unique strategy that you can play and put in place during your year-end planning appointment. And so the licensed tax advisor can map that out for you. Retirement investing, just be aware that starting in the early 70s, we have had the power since the early 70s. I think it's 1974. We've always had the power since that year to take our retirement and invest it outside of the stock market. Meaning that through self-directed IRA investing, through solo 401k investing, also known as checkbook control retirement accounts, that we can take our 401ks and IRAs and buy rental properties with them. We don't have to fully invest our money in the Tesla stocks, even though that probably was a great investment for you if you did. But we don't have to lock our retirement into the stock market, the US stock market. We can actually diversify that retirement portfolio outside of the stock market into real estate investing, into doing gap funding or short-term lending, or maybe even investing some of that money in real estate syndications. So just understand that you have options of how to invest your money in retirement now. And it's only become very popular over the past probably decade and a half but self-directed retirement investing has been around since about 1974. So it's a very unique investment vehicle. And if you want to talk more about that, obviously we are here and readily available to assist. Part of this wish list that Biden's administration hasn't passed, but they hopefully are voting on this week, are major changes to some parts of the Internal Revenue Code that have been around since the 1920s. I believe in 1921, and you know, don't quote me on this, but I believe that in 1921, the 1031 exchange part of the section 1031 of the Internal Revenue Code, which is the 1031 exchange, was put in place. That is probably one of the oldest parts of the Internal Revenue Code that is on the docket to change under the Biden administration's revenue code changes. I don't foresee this passing, to be honest with you. I think that there might be tweaks to this before it is passed, but I really don't see how they could pass the changes to the exchange part of the Internal Revenue Code for a number of reasons. One, I know the exchange industry creates over 630,000 jobs here in the United States and across the globe. Number two, it generates over $35 billion in revenue for the US government on an annual basis. Not in total, but $35 billion a year for the federal government in taxable revenue that they get to collect on a year-to-year basis. And let's face it, with all of the money that they've been, all of the dollars that they've been printing over the past 2 years, they're going to try to make up for that. Even though they tell us that the United States taxpayer is not going to have to foot the bill, we would be ignorant to think that that was true. I mean, to be real honest with you, tax rates are going to go up. This will be the most significant, like I mentioned earlier, this will be the most significant change to the Internal Revenue Code dating back to the 1920s. So I hope that the exchange part of the code doesn't go through. In fact, somebody told me the other day that they heard that it was actually removed from the Biden administration's Green Book. I haven't found that on any website yet. I've looked in a lot of, online for articles about this. I haven't found anything like that. So I think it's still in play. Number two, the changes to capital gain rates, which will probably impact real estate investors the most across the US. Right now, the way that the Green Book states capital gain tax to be changed is that if you are single and you sell a capital asset, let's say you've got $100,000 or like $200,000 of household income, you sell a capital asset like a rental property, and let's say you've got $500,000 in capital gain on that sale. And let's say you file single. Well, you have $200,000 of ordinary income, and let's call it $500,000 in capital gain. So overall, you have about $700,000 of income. Up to $500,000 of income, you still pay the ordinary long-term capital gain rate in this income bracket of about 20% federal. Then you've got 3.8% net investment tax and 9.3% to the state of California. But under the Green Book, under Biden's administration, every dollar above $500,000 in capital gain will be subject to 39.6% long-term capital gain tax, not 20%. Okay, that's for single. So $500,000 is the threshold. For married filing joint, the threshold is $1 million. So essentially the way this works is up until $1 million, you're good. You pay the ordinary long-term capital gain rate. But if that capital asset puts you above $1 million married filing joint or $500,000 as a single filing individual, every dollar above and beyond those thresholds is now subject to round up 40% long-term capital gain tax. I don't know where they got the 0.6 from, 39.6%. I have no idea. You might as well round up. It's at about 40%. That will impact real estate investors probably more than any other industry will be impacted, except for the long-term, stockbrokers investment portfolio. So we'll have to see how that impacts the U.S. economy. We're not going to feel the hit right away. Usually takes about 2 to 3 years for the United States taxpayer to feel the true impact of any major changes to the Internal Revenue Code. But I'm very interested to see what they vote on this week, what they pass this week. Hopefully it's this week, so we can bring you all of that information back in a couple weeks and give you all of the updates and what has been finalized. Once again, I do want to end on this slide just to let you know that we do offer free consultations here at Robert Hull & Associates. We can review 2 years of tax returns. We can check for any possible audit triggers on the filings, and then also put you on a periodic tax email update letting you know when our free webinars will be happening. I feel like just an internal feeling for myself, because I'm the only person who does webinars here. I feel like in 2022, we will be doing more webinars, probably almost double the webinars that we've done in 2021. Just because every year that we have major changes under Internal Revenue Code, make no mistake, if they vote on that this week, this code, these changes will be tweaked over the next year to probably year and a half. So even though they pass it maybe this week, it will not be final. It'll be final from a macro view, but they will continue to change and alter parts of that bill probably for the next 1.5 to 2 years. So just be aware of that. But we'll open it up for Q&A. I assume there's going to be questions.
Yes, yes, there is, Mr. Mr. Tony Watson. Yes, go ahead and stop sharing the screen so we can see everybody.
Yeah.
And okay, so we do have questions for you. One question is, what should agents be doing now to reduce their tax liability for 2021?
So for 2021, if you've already entertained the idea of incorporating and maybe started an LLC, there are creative ways to take that LLC that you've already started and backdate what's called an S election and convert your LLC into an S corporation. The S corporation happens to be one of the only entities that can actually save a self-employed individual income tax. In fact, it'll reduce your self-employment tax by upwards of about 60%. So that's for the individual who's already established as an LLC or even an S corporation. For those of you who are still very much sole proprietors, really the only way to reduce liability is to reinvest your profit back into infrastructure, upgrading office furniture, buying new computer equipment, maybe upgrading a cell phone or buying a Wi-Fi hotspot, or maybe even looking to purchase a new work vehicle. So, or even maxing out a SEP IRA. I mean, there's a lot of things that a self-employed individual can do. It really all depends on your scenario though. If you are not incorporated and you're new to real estate, you need to figure out first and foremost a way to effectively track your income and expenses, because that's what's going to give us as tax advisors all of the tools we need to assist in helping reduce liability. If you come in with just rough projections, sure, we can start there. That's a great starting point. But at the end of the day, it's not going to give you an accurate bottom line.
So Tony, what you really want to suggest, what you're suggesting is that they should have a separate bank account, right?
Absolutely. And it's not necessary unless you are incorporated. If you're an LLC or an S Corp, you are required to have an account under the EIN number of your business. If you are a sole proprietor still working directly under your primary social security number, it's not always necessary for you to have a business checking account. But from an organization standpoint, it definitely helps, because then you can have all of your personal income and personal expenses out of one account. And then under the business account, you can have everything that is business related.
So one of the questions, of course, was what's better, a C Corp, S Corp, or LLC, which you just answered. And S Corp is the best entity for real estate agents, correct?
So from a tax perspective, it tends to fall on the S corporation side. I am not an attorney, so I can't tell you legally which entity is better for you. So we will always have that conversation. Hey, if your attorney has promoted the C corporation to you, then it's for a legal benefit, not for a tax benefit. And a lot of times we'll have to bow out to attorneys because we also want to protect you from a legal standpoint. I don't find that to be very common though. Only with real estate syndications where people are doing crowdfunding or they're holding a specific trading license are they required to file as a specific entity. I can tell you right now, full transparency, about 95% of my real estate professionals are set up as LLCs, taxed as S corporations. So they get the best of both worlds. They get the great limited liability protection of an LLC, but they file income tax returns as an S corporation, 1120 S corporation. So you get the best of both worlds. You get the tax savings and the liability protection.
And Catherine, you had a question, please unmute yourself.
Yes, I did. Thank you. Just curious as far as business expenses go. I pay all my bills through my credit card.
Okay.
And then I pay off my credit card bill at the end of every month. As far as internet that I use for my business, that's grouped in with my cable together with Xfinity. Would you recommend that I pay those separately, put them into separate bills, have Xfinity bill me separately for internet and separately for cable so that I could write off the internet aspect?
I would actually probably pay for it all through your business account and then only take an allocated percentage for office space, based on square footage of office space. So the one thing that we don't want to happen is for you to pay for something personally when it actually is a business expense, because then all of a sudden you have this commingling situation. I'd rather it come out of your business first and then us take the allocation that is a business percentage. And then the rest of it would actually be part of what's called either an owner draw or an owner distribution. So we would have to allocate based on square footage of business use inside of your house to get the right dollar amount for the write-off.
Excellent. Thank you very much.
Mm-hmm.
Okay, Rudy had a question, but you want to know, can you open up an LLC now and file the 2021 tax on LLC, selecting the S Corp? If you haven't, of course, Tony answered this question, but if you haven't opened up an LLC now, why wouldn't you just go for S Corp in the beginning?
Well, that's correct. So if you open an LLC earlier this year, we can convert that to an S corporation for the full year of 2021. But that would mean that you had already started the LLC earlier in the year. If your question is starting an LLC today, November 17th, if you could receive the full year benefit by starting it on November 17th, but actually take it back to January 1st, no, unfortunately, that is not the case. You would only have and it takes about 2 to 3 weeks for the state of California to post the articles to the Secretary of State website. So you're really only looking at about a month of benefit in 2021, but starting January 1st of 2022 through the end of 2022, you'll have the full year benefit next year. But there's no way to backdate the actual incorporation date. If you're already incorporated as an entity, yes, we can convert you from one entity to the other, but only dating back to the original date of incorporation, unfortunately. So that kind of covers the incorporation start date and the game that you have to play. Some people think that by starting an entity now, that they can rerun all of the rest of the year's income through that entity. The problem is that your bank account has only been set up for a month. And so how are you going to run 100 grand, 200 grand in commission income through one bank account in a month when it's already been deposited to your personal bank account? It's just not possible.
Thank you. And also too, one thing to note, someone just asked, I think asked that too, is that one of the things, what can we do now to reduce our tax liability? You do know that you can charge things on your credit card now, and that will be deductible this year, even though you pay the credit card bill off in 2022. So you definitely can run business expenses on your credit card right now to take the deduction for 2021, even though you're paying in 2022. It's one thing. Do you have any other strategies that they can do right now to reduce their tax liability?
For those of you who are incorporated, you could always cut yourself a rent check out of your business, claim it on your personal return as rental income, and then allow it to be absorbed by the mortgage interest, property taxes, insurance improvements, HOA dues, and depreciation on your primary residence. But that really only works if you're already incorporated. If you're a sole proprietor, definitely take advantage of the in-home office deduction. But really the only way between now and December 31st to further reduce that income is to figure out things that you need to upgrade. Once again, new computer equipment, new furniture, prepayment for things like you had mentioned, prepaying for things that you have in January or February as expenses, but prepaying for those now and capturing it before December 31st. Also, maxing out deferred retirement. If you've already done all of the purchasing, if you don't need a new computer, you don't need a new car, you don't want to prepay for anything in January or February, max out your SEP IRA contribution. It can be up to 25% of your company's net profit. So if you have 100 grand in net revenue through your self-employed business and you've already fully deducted everything under the sun, you can take $25,000 of your $100,000 profit and put it into a SEP IRA, which is paying yourself, essentially. You're paying your own retirement account and you're deferring the tax on $25,000. Yes, you will pay tax when you go into retirement because once you start to liquidate that money, it becomes taxable to you. But remember that you're saving the money now and in hopes that all of that tax savings will allow you to reinvest that back into your business or hopefully help you buy more real estate.
And also too, couldn't they also pay their fourth quarter estimate in December of 2021 for the state of California? Because that's a deduction, right, on the federal tax?
Well, remember that it's limited to $10,000 because state and local income tax, the SALT deduction is limited to $10,000 total. So if their property taxes are already at 10 grand, let's say, or that plus state withholding through a W-2, if a spouse is a W-2, they're already maxed out on that. So prepaying the state of California would not be a benefit for most individuals. I'm not saying that it's not a benefit for all individuals, but we'd have to sit down and calculate what that benefit would be.
Okay. Then we also had a question. Can you unmute yourself, Antigone? I don't know if I'm pronouncing it right.
My name's Antigone, and I'm sorry, it's a tough one. I typed it in because I'm trying to make it clear. It's so gray, but I have a buyer, a client that has had rentals for a very long time, and her accountant told her just last year that she can no longer have a loss because she's not a real estate professional.
Well, that could be because her adjusted gross income is above $150,000. And if she is not a real estate professional, she has phased herself out from being allowed any loss deductions through her real estate investments. So as the code currently stands, if your AGI, your adjusted gross income is north of 150 grand, and you are not a real estate professional, neither you or a spouse are real estate professionals, they become unallowed passive losses. So if you have any negative numbers on any of your Schedule E rental investments, those, if your income is below $100,000, you're allowed up to a $25,000 net loss through your real estate investments. Once your AGI hits 100 grand, you start to phase out from being allowed that benefit, and you fully phase out from being allowed those losses as deductions at 150 grand adjusted gross income. So my assumption of this individual that you're talking about is that their AGI is above 150, number one, and number two, like you mentioned, they're not a real estate professional. If your AGI is above 150 and you click that box on your return, making you an active participant in all things real estate related, meaning that you're a real estate professional, the 150 AGI doesn't matter anymore. You could make $1 million adjusted gross income, and as a real estate professional, you're allowed full dollar for dollar deductible benefits under real estate related transactions and losses.
Thank you. That clarifies a lot. I appreciate it.
Absolutely.
Thank you. And Zach has a question. He wants to know if you can elaborate on buying a car before the end of 2021. Is it best to buy all cash or lease it for the biggest tax deduction? Like for instance, if it's a Mercedes that's under 6,000 pounds.
Yeah, so I mean, there are a number of scenarios, and unfortunately, I won't have time to go over all of them. But the whole goal here is to sit down first and foremost and map out your year-to-date income and year-to-date expenses to figure out where your net revenue lies. And that way we know what your effective tax rate is, what you're actually ending up paying in tax if you filed the return today with that level of income. If your tax rate, effective tax rate is 22%, for instance, and you've got 100 grand left over in net revenue, essentially every dollar that you take as a write-off to offset federal income is going to return you roughly 22 cents on the dollar in tax savings. So before the end of the year, if you're looking to buy a vehicle, if you're already actively looking to buy a vehicle and the vehicle weighs under 6,000 pounds, you have to acquire it by December 31st. But also here's another key part. The way that the Internal Revenue Code is written is not only do you have to buy the vehicle, you have to actually take ownership of the vehicle, meaning that you can't just put a down payment on the vehicle and then take ownership of it in January or February. It all goes off date placed in service. And so right now we're getting pretty close to the end of the year. So if you buy the vehicle and you actually physically take the keys and you can drive it off the lot or whatever, then yes, that would qualify for the bonus depreciation. If it's under 6,000 pounds, you get $18,000 in the first year of bonus depreciation, and then the remaining value is tapered off over the 5-year lifespan. If the vehicle weighs over 6,000 pounds, it qualifies for 100% bonus depreciation, making the full purchase tax deductible. Now, your question about buying it outright cash versus financing it, right now, because the financing rates are in the 2s. I mean, literally, US Bank just reached out to me a couple of weeks ago, said, hey, we want to refinance your car, or if you want to buy a new car, we'll give you a loan at 1.99%. That's as close to free money as free money gets, in my opinion. So me personally, I would, number one, a couple rules of business. Number one, always pay your employees. Number two, use other people's money to make money, right? And at 1.99% interest right now, which is what some banks are offering, I would much rather you put a low down payment, finance the difference, take the full write-off, take the tax savings, take all the cash that's still in your bank account because you didn't pay it outright cash, and go and buy real estate. That would be my advice. If you're looking at a 5% finance interest rate, yeah, I would. That's a much higher rate. It's still not a bad rate, but overall, I'd rather you pay that down as much as possible to have a lower monthly payment. So it really all depends. It really all depends because everybody's interest rate is going to be different. The tax savings is going to be different based on their year-to-date profit, so on and so forth. So we'd have to break that down in a more detailed manner.
For our last question before we announce our raffle winners. is what is the maximum exemption for California for self-employed that makes a gross income? Well, that's going to be tricky, Rudy, but okay. With a gross income between 200K and 250K.
What is the maximum? I'm sorry.
The maximum exemption for California? Yeah, Rudy, I think the issue with that, you're saying gross income because your taxes are based on net income. So we want to say net income between 200K and 250K. What would be the maximum exemption for California?
What do you mean by exemption though? What maximum exemption? I'm not understanding.
Rudy, you want to unmute yourself to see exactly what you're trying to ask?
Yeah, sorry about that. You had mentioned something that the state had a certain amount of money that they allowed in tax deductions, like a standardized amount, like 30,000, you said, up to a certain amount of money, but California was different. You had mentioned it earlier.
Well, I mean, the standard deduction on the federal side.
The
standard deduction is about 25 grand on the federal side. The state should be very comparable to 2020. It doesn't always adjust. I think California actually will adjust with inflation now. But yeah, I hadn't talked about the standard deduction earlier. So I think we were talking about the SALT deduction, the state and local tax deduction, and that currently is at $10,000. State income tax that you pay to the state of California is not a state write-off. Property taxes are a write-off, but what you actually pay in state of California income tax is only ever going to be a federal write-off, and that currently is limited to $10,000 total between federal income, between state income tax and property taxes on both your prime
and DMV.
Yeah, and that could potentially be jumping to $80,000 in 2022. But when they do that, when they adjust your state and local tax deduction like that, when they go from 10,000 to 80,000, they will also reintroduce an adjustment to alternative minimum tax, which is to keep the wealthy of the world from deducting 80 grand in state and local taxes. Everybody thinks that the wealthy are going to get the greatest bang for their buck. And sure, in certain aspects of the Internal Revenue Code, once again, a billionaire is always going to be a billionaire. They're never going to be, starving essentially, because they have enough money to make a lot of money. That 80 grand write-off is not going to save them very much because they are 1000% subject to alternative minimum tax. And at that point, they're not allowed any of their state and local tax deductions, at least on their primary residence and their second homes. So that's a lot of what the general public doesn't understand about the Internal Revenue Code. They see what is written in the news media outlets, and whether they fall on the left or fall on the right or fall in the more liberal column, they aren't tax professionals, the people who write these articles for the most part. So, and I did read an article this morning, actually in the Wall Street Journal, where they did have this, they had about 7 paragraphs of tax information, and the very last 4 sentences of this almost 5-page or a 5-paragraph article, they mentioned 2 things about alternative minimum tax. But they were just bashing the whole $10,000 to $80,000 and how it was going to give the wealthy this huge tax savings. And unfortunately, that's just not the case. Yeah. Alternative minimum tax has always disallowed your state and local tax deduction. So up until 2018, most people weren't even allowed their state and local tax deductions as write-offs because of alternative minimum tax. And that dates it, once again, all the way back to the early 80s. Right. So this is not on you to understand, though. That's probably one of the most important points for me to leave you with. This is not something that is easily just pulled up on a website and for you to learn it in a 5-minute read. This is something that we study over 750 hours a year on. We have over 750 hours a year in income tax education. That we coach ourselves and we teach our team, and also years and years of experience that we can help and advise you and navigate around some of these more significant limitations. So you better understand where you're getting the best bang for your buck.
Thank you, Tony. So I put in the chat box contact information, especially for those of you who are on your network's government board. It's great to have them come out to speak at your network, at your association. They're awesome strategic partners. So I definitely put that in the chat box. And so if you have any questions, Zach and others, please reach out. And Tony, if you could do me a favor and put your contact information in the chat box, that'd be great, because people have questions so they can reach out to you directly also. So at this time, let's do, thank you. Hiroko is reminding me, let's thank you again, Mr. Tony Watson, for providing us with this awesome information, very helpful information. And to also add to it too, remember, you can also start booking on, paying your dues, your MLS dues, your association dues, any education things you want to do next year, pay them now on a credit card so you can deduct it. So again, thank you, Tony. And now we want to go ahead and announce our raffle winners. And he put his information in the chat box so that you guys can reach out to him directly. So we do have raffle winners. So let's see who they are. And all of our raffle prizes is coming from our strategic partner, Robert Hall and Associates. And our first one we have for a $25 Amazon gift card is Kate Timpson. And she was one of our 2021 local network presidents. Kat Timpson, should I say.
Thanks, guys. Wow, that's so cool. We're in New Jersey, by the way, so this is great to know that you guys at Robert Hall and Associates are 50 states worth. So thanks, and thanks, Tawny, for the invite.
Of course. You know I love my Women's Council sisters. And our next winner is another local president, 2021 local network president is Cassandra Oliver. I think she's president of Cobb Network in Georgia.
Congratulations.
So we'll get that out to her. These are all Amazon gift cards that you'll be receiving via email. And our last winner is for $50 Amazon gift card from Robert Hall and Associates. Oh, Kay Merg, our 2022 state California president. And also, by the way, she is called the referral queen. That woman is one of the top Women's Council sisters who receives a lot of referral nationwide. So she's also great to have come out to networks to tell, teach on how to really maximize Women's Council #1 benefit, which is referrals.
Thank you, Tony and team. Great job today.
Thank you, Prezi. Okay. So for those of you who are not part of Women's Council, we would like to invite you to join our awesome network today. All right. Our membership dues are $259, which is broken down with you belong to our national, which is $140. You also belong to our state network and our local network. Again, we are the top referral network. And here's information to join us. Either you call us at 323-546-9099 or email us at wcrlabh@gmail.com. And again, the great thing about us, plenty of opportunities. So before we go at 2:30, we like to end things on time. Let's finish up networking here. Again, I would like to thank Mayor of Malibu, Mr. Paul, for joining us.
Thank you very much.
And also like to thank our state 2022 President Kay Merg for joining us. And I see we have some of our government board members on here. Let's start with our 2022 President-elect. Say it with pride, Cindy Wu.
Thank you for coming, everyone.
So let's do this. Let's say our name. Let's say our name, the network we're with, and the area we serve, and why it's great to buy in that area. Let's go with you, Kat, our winner.
Oh, thanks, you guys. So I'm in New Jersey, which makes it awesome for a referral because we're right outside of New York. So if anybody is coming from California, love to have the referral. I have my PMN, and I serve basically the Midtown Direct right outside of New York City in New Jersey.
So why is it good for us to come there and buy?
Well, actually buying is really difficult. Being honest, we really have an incredibly difficult market for the buyers. But hey, if you're with the right realtor, you guys know it makes all the difference. And it's about knowing people in the area and in the industry and doing a great job for our clients. So really, this kind of thing, if you aren't already a member, please understand how important it is to network with each other, because I always feel like if I have an offer in and it's apples to apples, and I'm working with someone who knows me, most likely they'll urge their client to work with me and my clients because they know I'm going to come to the closing table. They know I'm going to do everything to make it a good experience, or as good experience as I can. So it's about relationships again. But yeah, we are here to help anyone because people sometimes just need to come east, right?
Yes, ma'am. So Kat, be sure to put your contact information in the chat box. And
You got it.
everybody remember
Thanks.
to save the chat box. What about you, Miss Ann? I know we got a couple Anns here, but Ann, you, I think, is on.
Hi, everyone.
Hi.
I'm selling at the Porter Ranch community for Toll Brothers, and currently.
And tell us where Porter Ranch is in the state city area.
Okay, so Porter Ranch is north of Hollywood, so about 30 minutes north of Hollywood. It's very not known location yet because I work with new construction. So it's for Toll
In
Brothers.
California, by the way.
Yes, I'm sorry, California. So
and
I
next
know-
to Magic Mountain might be the best way to say it.
So if you've been to California, we're north 30 minutes from Hollywood. So I think that's a better pinpoint the location. So we do have homes available. We do have availability. We're selling models right now. So pricing at 2.9 and 3 million. So if you have buyers, you want to send referrals, we do co-op, and for 70,000 for those two homes right now.
Okay, so Ann, please put your website information in the chat box, please.
Okay.
So Anne is our first vice president of our network 2022.
Yes. You have to turn your volume up, Prezi. Hiroko, turn your volume up. Okay, what about Nadia? Are you there, Nadia? What about you, Zach? Danielle? Okay, we're gonna go with our Cindy Wu.
Hi, everyone. My name is Cindy Wu, President-elect for Women's Council LA-Beverly Hills. I basically service anywhere from San Gabriel Valley to San Fernando Valley. So in the Los Angeles County, basically east to west, that covers San Gabriel Valley, which is pretty heavily, is very diverse. Asian population, you have Little Taipei there, Little Tokyo, Koreatown, Chinatown, and moving west, you have West Side, Bel Air, Beverly Hills, San Fernando Valley, Santa Clarita. So what's great about the location is that in the San Gabriel Valley, there are a lot of big lots available, so somewhere around 10,000 square feet. Currently, Los Angeles County or City of Los Angeles or LA County in general, you could do ADU, could build up to 4 units. Within, zoned residential, you could build up to 4 units. Fairly easy to do. So you'll find lots of big lots on the east side of LA. On the west side, there are some available as well. I would say price ranges from about, for a single family, ranges from $650 up to obviously millions. And as Ann just mentioned, the new development, you could actually find new development about 1.2 in the San Gabriel Valley as well. And on the west side, it goes up a little bit more. But we are facing shortage of inventory, but there are still lots of people that is available to sell if the price is right. And I also service commercial as well. So if any of you that is have clients looking to purchase warehouses or looking for land to develop, let me know as well. And I'm also involved in international real estate. Thank you.
Definitely put your information in the chat box, President-elect. What about you, Felisa? I just saw you on camera. Felisa Kohan? If you can mute yourself. There you go. Unmute.
Hi there.
Hi.
Hi. So my office is in Santa Monica, and I serve Greater LA. Pocket listings that I'm not allowed to share, I guess. Thank you for this meeting. It was wonderful. Appreciate it.
Well, thank you for coming, and also become a member of our network. As you see, as our president-elect has it up there, say it with pride, LA-Beverly Hills. Come and join us.
Thank you.
And Danielle, we want to ask our guests before us locals talk more about what we do.
And I'm sorry, I need to go to my next meeting.
Understand. Thank you for joining us.
Thank you.
Okay, so let's go with our president, Hiroko. So then we will end at 2:30.
Okay, thank you so much. So I think it's already 2:30, and thank you again.
It's 2:29, so you got a minute.
Thank you for coming, and then we will make a mini event almost once a month next year, and we are planning, and then we're gonna announce.
Speak, your volume's low.
Oh, sorry. Oh, in some reason. Can you hear me? Okay, almost. Okay. Yeah, so we will make more event next year, and then will be announced very soon. So I'm looking forward to seeing you again soon. Thank you.
Thank you. So it is 2:30, so that ends our program. Thank you everyone for attending.